Hello, my dear listeners. In today's video, I will continue to talk about sovereign debt crisis and how it affects uh, gold and silver and cryptocurrencies. So the first chart here in blue, it's S&P 500. In yellow, it's the XY dollar index, and there is a daily. It's a daily chart of gold. Okay, so what you can notice, what is interesting, like to say about that, it's from this part here about beginning of October. We have dollar index going sideways, and the gold has been rising. And well, we also have a decline. We also have a rising gold in a declining sharply declining S&P 500. So this is important because, like I said in the previous video, dollar index, it's basically dollar against a euro, Japanese yen, and British pound mostly, and that can be easily manipulated. But what we should pay attention is how gold performs against other assets, because this is really stating the confidence in the currency and state of inflation. Now, what some analysts has to say about recent positive GDP numbers. Let's listen.
Back on the table. Rate hikes by design eventually cause an economy to contract. The latest GDP data should be viewed in context of other key data, other events, such as the latest employment numbers, for example. The latest jobless claims for the week ended October the 21st, released late this week, shows that jobless claims increased by 10,000 to 210,000. This is higher than expected. The expectation was 208,000 claims. Then we can also look at the latest manufacturing data. According to Kansas City Federal Reserve, manufacturing stalled in October. Indices for production, shipments, and order backlog all cooled moderately during the month, while new orders fell significantly. Employment fell slightly as well, and inventories were unchanged. This is all according to the report published by Kansas City Federal Reserve. So these are the facts that should be taken into account too. The Federal Reserve will use Q3 GDP data to decide whether another rate hike is necessary.
Okay, so well, this is one of the also like independent reporters who noticing that the government's statistics are not reflecting what is going on with the real economy on the ground. And this is a part of the campaign to keep confidence to allow the government to run a larger deficit at the end. Otherwise, if this confidence is gone, there will be no possibility. And what is the major shift is going to happen? Like it's already happening. Like it's been going on since last year, since the dollarization is started internationally. So listen, why I think it will be extremely hard to print more debt without the consequences. Please listen to this Peter Schiff latest podcast testimony.
For an interest payment crisis, and so at least they're writing about this, but they still don't get the severity of this. And it's not just the interest payments; it's the principal. It's not just that we can't pay the interest, but we have to pay the principal. You know, for years, people used to tell me, Peter, why are you worried about the debt? You know, we never have to pay that back. All that counts is the interest. We have to pay the interest, but we don't have to pay back the principal. In fact, if you ask most experts today, they'll say the same thing. We don't have to pay the principal. Well, my response to that was always, what do you mean? We don't have to pay back the money. I mean, we borrowed it. It's a loan. I mean, that's the whole nature of a loan, right? This isn't a gift that we got. The national debt wasn't a gift. It's debt. By its nature, debt has to be repaid. So when they would say we don't have to repay the debt, I would say, well, did you run that by the Chinese? Did you run it by the Japanese? Did they know that that's the deal? Did they know that they're loaning us money, but they're never going to get it back? Because, that's not a loan. That is a gift. They're not giving us this money. They are loaning it, and that means they expect to get it back. Now, of course, what people would tell me is, well, of course we will pay them back because we'll borrow it from somebody else. So in other words, it's a Ponzi scheme, right? So Bernie Madoff never had to worry about paying back money because he would get it from the next sucker who didn't realize it was a Ponzi scheme. But what happens when people realize it's a Ponzi scheme? They don't want to participate. And
okay, so this is a very important point that Peter Schiff makes, because now it's not like because we can everybody says, okay, we don't have to worry about American debt because we have to only pay the interest. But now, no, if the situation shifts and there is no more buyers, so the Fed will have to monetize everything, and this is. We're looking at the level of monetization we never seen. They've been able to get away from it by raising, lately the interest rate up to the 5%. So the latest buyers, I assume, I'm looking this for trader, investor perspective. They say, okay, we're going to buy it at 5%, expecting the rate cuts. So we're going to capitalize on on a capital gain, because we're gonna buy our bond at 5% and sell it when the rate, let's say, will be at 4.5 or 4%. So this is maybe like, you know, calculation why they've been able to in the past 12 months. But if we're going forward and they will have to start cutting rates, there is not going to be as many buyers, and previous buyers going to be exiting their positions. Like there's will be, and long-term holders have China and Japan, even the biggest United States ally, it's Japan. It been not sellers of the U.S. Treasuries because they are themselves in trouble in their debt crisis. So they have to sell dollars. So you see there is many factors that we will see the QE in the next 12 months, in my opinion, that we have never seen before. And this will put everything like, you know, what's in the stock market related to mortgage-backed security, to banking sector, treasury, consumption. This will be a very sharp decline, and there will be flights of some capital to assets that don't have a counterparty risk. That's why I think the gold, silver, commodities in general, and cryptocurrencies will do extremely well. They will do well. They will do, and the one I'm holding in and I'm recommending it's XRP, because, well, this is the one that will be used for the utility in next generation of the payment system, and the transition it has to be completed to the new payment system by 2024. So this token will be used by the larger institution and banks to for the settlements. I said like my estimate, the most optimistic scenario, I'd see maybe $1.20 before the end of the year. You know, this trend line, mid expectation if the bull trade continued, maybe testing to 84 cents before the end of the year. On the downside, we have a support here, 44 cents. If everything you know, goes south in the cryptocurrency market, the risk possibility, well, you have 4 cents. But you know, I think right now it's very good to have a position, and if you're lucky to buy a lower, I will be adding to this. But my position is already been there, and I've been holding this asset through for years, and I have a strong conviction in it. So this is going to be it for this video. Please like it to help me to get more views, to motivate me to continue to do these videos, and I talk to you soon again. Thanks for watching.